Hey guys, this is the Trading for Dummies series brought to you by Mastermind Trading. Introduction. In recent video, we've looked at some of the kind of indicators that we have, as well as how traders look to use indicators. Now in this video, we want to look at what usually happens when there's a discrepancy, when there's a disagreement between the signal you're getting from your indicator and the signal you are getting from your price chart. So basically the concept is known as divergence in trading, and divergence in technical analysis basically occurs when the price of an asset moves in opposite direction of a related technical indicator or oscillator. So let's say the trader is using the RSI, the MACD, or whatever indicator, trend-based indicator, and then is getting a bullish signal on his indicator, and on the price chart the price is forming a bearish trend. Obviously there's a disagreement, there's some sort of like an opposing bias between that indicator signals and the obvious signal that is on the price chart, price breaking the, let's say, the prevailing uptrend for a new downtrend. So basically there are two ways of classifying divergence. There is the regular divergence and there's the hidden divergence. We'll look at the both of them in successive slides. Regardless of which the case is, whether it is a regular divergence or a hidden divergence, there are two basic ways of identifying divergence, which is the bullish and bearish divergence, which is how we are going to look at it in the course of this video. The regular bullish divergence occurs when price is making a new low and the indicator is making a new high, signaling the start of an uptrend. Meanwhile, the regular bearish divergence occurs when price is making a new high and your indicator is making a new low, a new lower high, signaling the start of a downtrend. This would usually signify that the trend is weak and might be beginning to reverse. On the other hand, in the case of a bullish hidden divergence, you have price making a new higher low, meanwhile the indicator is still making a new lower low. Lastly, we have the bearish hidden divergence, which occurs when price makes a new lower high while the indicator is still making higher high. I have included a few of this illustration that explains this. Now in this illustration you can see price making higher lows while price making lower lows while the indicator is making higher high. And then you can see from the follow up right here, price kind of just broke through and moved in the direction of an uptrend. In this case, you can find price making lower highs while the indicator is making higher high, and price, instead of going in the direction of the indicator, kind of just continuing the direction of the price chart, which is forming new lows. Here you can find price making higher high while the indicator is making a lower high, and then price going in the direction of a downtrend. While here you can find price forming lower lows while the indicator forming lower highs, and price moving in the direction of the uptrend. So guys, that's it for divergence trading. Please note that this is not financial advice, this is strictly for educational purposes. I am not an indicator based trader, so you should not take my words for financial advice. I remain Monaco Daniel, the mastermind trader from the world's most populous black nation. See you all in the next video.